The Federal Reserve's protracted efforts to tame alarmingly high inflation in the US had barely started to yield results when weaker links in the country's banking sector started to snap. 3 US banks, Silvergate Bank, Silicon Valley Bank, and the Signature Bank went belly up in a matter of days in early March, while the government coaxed larger banks to take over the First Republic Bank and prevent it from capsizing. The US Treasury and the Federal Reserve have acted quickly to prevent panic, with the government seizing some banks and guaranteeing depositors' savings. Subsequently, the Fed opened a liquidity window for banks to prevent funding channels from freezing. Some experts differ, however. They argue that these actions will make banks continue to take risky bets, secure in the knowledge that the Fed will protect depositors, like in the case of SVB, where bond and equity investors suffered losses, but the Fed saved all depositors, even the uninsured ones. Essentially, the SVB crisis resulted from interest rate risk that stemmed from the Fed's rate hikes. The rapid increase in policy rates eroded the value of SVB's extensive bond holdings. Then, large-scale withdrawals were the final nail in SVB's coffin. Experts point to glaring gaps in SVB's management of interest rate risk. Some have already referred to the Fed's liquidity window as a fresh form of quantitative easing that runs counter to inflation management. A softening of the Fed's approach to inflation implies financial market dominance over policy, possibly at the cost of macroeconomic goals such as inflation management.
My understanding is that in any kind of bailout or support, there is an element of moral hazard involved, because the bailout is invariably in response to some kind of stress that has been brought about by not adhering strictly to regulatory norms or because of poor governance standards. In the specific case of SVB, we know that they didn't have a chief risk officer, for instance, for a year or so. So there is an element of moral hazard involved in any kind of government support to a stressed entity, because it just encourages other entities to take on that kind of stress. If the markets and financial entities are really driving Fed decisions and kind of arm twisting in a sort of a perverse sense, them to abandon some of their core macro targets or agenda, then there is another moral hazard.
Analysts did say, however, that so far the current episode is not an international contagion like the global financial crisis of 2008, and the official response is unlikely to flood markets with cheap liquidity and reverse the fight against inflation.
The current dynamics that you are looking at are not very similar to what we saw in 2008, where it was a banking crisis altogether, and we actually saw a systemic failure, which led to the policymakers sort of getting into a full-fledged policy support mode. I think currently we have to consider two factors, especially the fact that the US economy is growing more than 2.5-3% so far this year, and global growth is also around 3%. Despite the kind of rate hikes that we saw in the last 1 year, which have not been able to engineer a very sharp slowdown as yet. And the playbook for resolution of failing financial institutions like Credit Suisse is already well developed now. Both of these factors stand in contrast to 2008, and hence I think the probability of a negative feedback loop is looking to be low.
Comparisons to the global financial crisis notwithstanding, the latest bailouts raise questions about lapses in risk management and banks considering themselves too big to be allowed to fail.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve.
the nation's trusted bank, SBI, the banker to every Indian.